Don't forget to like and subscribe to stay in the loop on all things finance. The U.S. stock market is having a rough go of it this week, with the Dow Jones potentially facing its worst week since March 2023. And that's a pretty big deal because it signals a serious loss of confidence among investors. So let's unpack what's driving this market turmoil, starting with President Trump's trade policies. A one-month delay was announced on tariffs for Mexican imports compliant with the USMCA trade agreement, but this has done little to calm investor anxieties. Remember when the market reacted positively to a similar delay for automakers? Well, that optimism faded quickly as the unpredictable nature of these trade negotiations continues to spook investors. They're struggling to anticipate future developments, which creates volatility in the market. Now, adding to the market's woes is a cooling down of the previously red-hot AI sector. Chipmaker Marvell Technology saw a significant drop in its stock price even after exceeding analyst forecasts and projecting substantial revenue growth. This might seem counterintuitive, but investors who had become accustomed to AI-related companies consistently outperforming expectations are now reacting to any sign of a slowdown. You see, the bar was set so high that even meeting expectations isn't enough anymore. This shift in sentiment is also impacting industry giants like Nvidia and Broadcom. And to make matters even more complex, the emergence of Chinese competitors in the AI space, such as DeepSeek and Alibaba, is fueling concerns about the long-term dominance of U.S. companies. These Chinese companies are challenging the technological superiority of U.S. companies, which adds another layer of uncertainty for investors. Now let's shift gears and look beyond trade tensions and the AI slowdown to some broader economic warning signs that are flashing red. A surge in layoff announcements reaching levels not seen since 2020 is raising concerns about the strength of the U.S. job market. U.S.-based employers announced plans to slash a staggering 172,017 jobs last month, a 103% increase from January, and the highest February total since 2009. To put that in perspective, imagine the entire population of Salt Lake City suddenly losing their jobs. That's the scale of the layoffs we're talking about. While a robust job market has been a key factor in preventing a recession, these recent warnings from major retailers like Macy's and Victoria's Secret suggest that consumer spending, the engine of our economy, may be sputtering. Macy's reported weaker than expected revenue, and Victoria's Secret, while exceeding sales and profit forecasts for the last quarter, gave a revenue forecast for the upcoming year that fell short of analysts' expectations. This isn't just about a couple of struggling retailers. It's a sign that consumer confidence might be waning, and that could have a ripple effect on the entire economy. But hold on, there's more to this story. Reports from the Federal Reserve and the Institute for Supply Management highlight anxieties over rising input costs due to tariffs potentially fueling inflation. This means that businesses are paying more for raw materials and goods because of the tariffs, and they may have to pass those increased costs onto consumers in the form of higher prices. So you've got trade uncertainties, a cooling AI sector, and weakening economic indicators, a perfect storm burning in the financial markets. All of this is creating a very real fear of stagflation. What is stagflation? Well, it's like the worst of both worlds, a stagnant economy with high inflation. It's a challenging economic scenario that's difficult for policymakers to address and can have a significant impact on your daily life. Imagine paying more for everything while your income stays the same or even decreases. That's the harsh reality of stagflation. Investors are anxiously awaiting Friday's jobs report from the U.S. Labor Department, hoping for some clarity on the health of the economy. A solid job market has been crucial in supporting consumer spending and preventing a recession, but those cracks we mentioned earlier are starting to widen. This brings us to a critical question. Are these market jitters just a temporary blip, or are we on the precipice of a more significant economic downturn? And to unpack that question further, we need to take a global perspective and see how international markets are reacting to this turmoil, and that's where we'll pick up in part 2 of this deep dive. Don't forget to like and subscribe so you don't miss it. While the U.S. grapples with all these economic challenges, international markets are kind of painting a mixed picture. European indexes have largely risen following an anticipated interest rate cut by the European Central Bank. This move signals that the ECB is trying to stimulate economic growth by making it cheaper for businesses to borrow money. German stocks in particular experienced a rally driven by a policy shift towards increased government borrowing. This is a significant departure from Germany's traditional fiscal conservatism and suggests a willingness to take on more debt to boost the economy. Asian markets also saw gains with substantial increases in Hong Kong and Shanghai. China's Commerce Minister, while acknowledging the negative impact of a trade war, remains defiant. They emphasized China's resilience and asserted that the country will not yield to bullying tactics. This stance highlights the complex geopolitical dynamics at play in the global economy. Back in the U.S., the 10-year Treasury yield has risen to 4.30%. What does this mean for you? Well, the 10-year Treasury yield is a benchmark interest rate that affects everything from mortgage rates to the cost of borrowing for businesses. When this yield goes up, it generally means that borrowing costs are increasing, which can put a damper on economic activity. Experts warn that tariff-induced inflation coupled with slower economic growth could push the U.S. economy dangerously close to stagflation. Remember that stagflation is a nasty combination of high inflation and slow economic growth. It can lead to a decline in living standards as prices rise while wages stagnate. The coming days will be crucial in determining the direction of the market. Friday's jobs report set to be released by the Bureau of Labor Statistics will provide further insight into the health of the U.S. economy. This report will shed light on the strength of the job market, a critical factor in sustaining consumer spending and preventing a recession. So what does all of this mean for you? The current market volatility serves as a stark reminder that we live in an interconnected global economy, and geopolitical events can have a significant impact on your investments and your financial well-being. So the future trajectory of the U.S. stock market really hinges on a multitude of factors. Will the trade dispute be resolved? Can the AI sector regain its momentum? And will the U.S. economy be able to weather this current storm? These are just some of the questions investors are grappling with as they try to, navigate these turbulent times. Remember, knowledge is power, and staying informed and engaged can help you make better financial decisions. To be sure to like and subscribe for more deep dives into the forces shaping our world. Until next time.